And I am reporting live from Hampton University, where we will cover the WSLS Incorporated presentation on the accounting cycle. WSLS is a team of 4 Hampton alumni, and they are returning for a community event to introduce students about accounting there on this evening. They are participating in a panel discussion held in Scripps Auditorium. And my counterpart, Kayla Evans, will be facilitating the discussion. Stay tuned to take a look inside.
Thank you all for being here today. Would you mind introducing yourselves? And then Ms. Hamilton, can you give us an insight into accounting?
We are a team of Hampton alumni returning to our home by the sea. My name is Lindsay Hamilton. I'm Kenna Farmer.
My name is Will Wilson.
My name is Samantha Robinson. And we wanted to thank the School of Journalism for broadcasting our presentation today for everyone to see. We will be discussing the importance of the accounting cycle and how it's used within the company. I want you all to close your eyes and think about your favorite places to shop. Do you understand why, when, where, and how the clothes get from the company to you? If not, today's your lucky day. The purpose of this workshop is to show how the accounting cycle works and how it applies to everyday activities, even if something is typical of shopping. Common myths include accounting is all numbers, it's not as necessary as everyone makes it seem, it's a boring desk job, and it's too complicated to understand. In actuality, accounting is more of an analysis subject. It's necessary regardless of concentration, occupation, or socioeconomic status. It is necessary required for a comfort field and is actually quite interesting. Accounting is a system that examines a company's business activities by relevant information using 3 very simple steps: identifying, recording, and communicating. These 3 steps deeply analyze what the company does with their money and how it factors into their general operations, and provides an opportunity for the comparison to ensure the company is using their money as they should. The next question to ask is, if we understand what accounting truly means, when we say the company, who does that entail? There are internal and external users. Internal users are primary users, typically consisting of people working inside of the group, such as managers, officers, sales staff, and controllers. While external users, secondary users, consist of those who focus on the outside of the company, such as lenders, consumer groups, shareholders, and customers. There are 2 different forms of accounting.
Ms. Hamilton, are there different forms of accounting, and how does this contribute to the cycle?
Accrual-based accounting is the money that you owe for a service or a good. And cash-based accounting records revenue and expenses when actual cash is being released. Now, when we consider accounting, there's a basic accounting equation that we want to follow. Assets equals liabilities plus equity. And there are also multiple other accounts we'll be talking about in the workshop tomorrow. The accounts are classified into 5 different groups. Assets is what the company has. Liabilities are what the company is being held liable to do. Equity is dealing with the work. Revenue is what the company makes, and expenses are what the company has to pay. The statements include the balance sheet, income statement, and statement of retained earnings, which will be discussed later. Now, when you think about accounting, you have to remember that there are always rules. It's how we live in a society, there are laws. And those rules are called the GAAP principles. These principles, are the ways to govern transactions are made. Each individual principle separately deals with a different entity within accounting. The principles are as follows: cost principle, revenue recognition, matching, full disclosure, going concern assumption, monetary unit assumption, and time period assumption.
Ms. Farmer, where do we start with this accounting cycle?
Hi, so once again, I'm Kenna Farmer, and I'm going to tell you about the first 3 steps in the accounting cycle. The first step of the accounting cycle is identifying and analyzing business transactions. Now, all the transactions are going to be reported in the accounting process. This is because only some transactions are pertaining to the actual business entity. For example, if there's an owner and the owner makes a loan and has nothing to do with the actual business, it shouldn't be reported because it didn't affect the business and money coming in or out. The transactions that are analyzed are determined by the amount that should be reported. Here is where you prepare business documents to serve as the foundation for the reporting of the transaction. The second part is reporting in a journal. This is when someone actually writes down the transactions. It can either be electronic or it can be in an actual physical book. Business transactions are recorded using double entry bookkeeping system. This means that are reported in journal entries that contain at least 2 different accounts. One's going to be debited and one's going to be credited. The reason why one's debited and one's credited is because, one, the company is either receiving or giving out a thing, or an asset, or a different account. To simplify the
Okay, now what comes after that?
Okay, so the third and final one that I'm going to be talking about is posting into the ledger. The ledger is a collection of accounts that show changes made to each account as a result of past transactions from the current balance. After posting all the transactions into the ledger, the balances of each account is now determined. For example, all general entries are debited and credited to cash will be transferred into the cash account of the ledger and we'll be able to calculate the increase and decrease in the cash, thus ending the balance of cash and can be determined. This is done on what we call T accounts. So in T accounts, it's like a big T like that. On one side, you put the credits, on one side, you put the debits. Credits are like negative amounts, and debits are like positive amounts. So you add up all the negatives, you add up all the positives, and then you put them together, whatever it is, that's what you're going to have to put.
Mr. Wilson, would you mind describing what happens in terms of recording with the unadjusted trial balance?
All right, so moving forward. After the trial balance, some transactions result in money being accrued and or deferred. It is important to account for these transactions with adjusting journal entries. The unadjusted trial balance is the listing of all accounts used before any adjustments are recorded. We use them to make sure our debits and credits are equal after T accounts. Next, we have adjusting entries. Adjusting entries represent transactions that haven't been recorded. There's an original entry, there's an adjustment entry, which records some type of movement of cash. Lastly, you record any changes are recorded in adjusting general ledger/T accounts. Adjusting entries also account for the depreciation of an asset.
Once at that point, what do we do with these adjustments?
Now that we know what adjusting entries are, it's important to know what type of entries there are. There are 4 of them, and they are accounts payable, accounts receivable, unearned revenue, and prepaid expenses.
Mr. Wilson, what do you do once the adjusting entries are complete?
Once your adjusting entries are complete, you create a new trial balance, which is called the adjusted trial balance. You use the adjusted trial balance to make sure your debits match your credits after adjustments, which includes temporary and permanent accounts. Temporary accounts include your income statements, your dividends, and your income summary account. Permanent accounts include assets, liabilities, common stock, and retained earnings. After the adjusted trial balance is finished, you will next move on to your closing entries.
Ms. Robinson, considering what Ms. Hamilton, Ms. Farmer, and Mr. Wilson have explained, how do we close?
So the next step of the accounting cycle is recording your closing entries. In this step, it requires for your temporary accounts to go into your permanent accounts. Now you have to make sure all the following temporary accounts equal to 0. Your revenue accounts, your expense accounts, your dividends, and your retained earnings. Also take note that the income summary actually debits your expenses and credit to revenue. Now your closing entries need for your revenue to be credited, your expenses to be debited, and the income summary to go into the statement of retained earnings as well as dividends going into retained earnings as well.
At this point, in the ending steps, what do we do last, Ms. Robinson?
The next step in the accounting cycle is making your financial statements. So the 3 financial statements that we use is your balance sheet, your statement of retained earnings, and your income statement. So basically anything leading up to now, like your adjusting entries from your adjusted trial balance, you would account for all of that as well as your closing entries and put that into your financial statements. Now the last step of the accounting cycle is reporting your post-closing trial balance. Basically, everything before this point led to this. So this is the final step of the accounting cycle, and basically it's just finalizing everything and writing down all of your final accounts. And that concludes our presentation.
All right, guys, so thank you so much for coming out today and listening to our panel discussion. And we hope to see you tomorrow, May 1st, 2017, at our workshop.
Well, that's all we have for you today, folks. Thanks for tuning in. Feel free to attend the workshop hosted by WSLS on May 1st, 2017, where they will really dig deep and explain the accounting cycle. For all of the students out there, remember to come out this upcoming Monday night to learn more and be safe.